Hi everybody, and welcome to the Q3 recap video and an outlook for fourth quarter of 2020. I'm Alex Leonida, Chief Investment Officer of Capital Financial Group, and I'm pleased to be with you guys today so you can get a little bit of a handle on our thought process, our outlook, both from a geopolitical and macroeconomic perspective. And as always, we're going to jump in and we're going to give you guys kind of some guidance on general asset allocation strategy and what we're implementing in client portfolios right now. All right, so without further ado, we're going to jump into some data from the third quarter. We're going to talk about U.S. markets, international markets, and we're going to touch on some political stuff going on to keep everybody in the loop. All right, so first up, we have the U.S. stock market. It has been a totally crazy year. Realistically speaking, we've never seen anything like this. I mean, I've been doing this for 14 years now, and this has been more wild and crazy than even the Great Recession of 2008, 2009. But our stock market has proven really, really resilient this year. We've seen the S&P and the NASDAQ both turn positive. I mean, the NASDAQ's been going gangbusters for basically the last 6 straight months since April, and then the S&P finally turned positive, and we are back to even on the Dow. The NASDAQ has dramatically outperformed. I mean, there's plenty of reasons why that might be the case, but I think more than anything, it is the shift to e-commerce, more online activity, more tech growth than anything you could possibly see in brick and mortar or standard retail. Any of the traditional old school types of ways of doing business have really fallen by the wayside with all of the quarantines, people being a little bit unnerved and uncomfortable going about their daily lives in the traditional sense. So tech has really driven the overall market performance, and a handful of stocks have been the drivers behind that tech boom. So S&P up a little bit on the year, but obviously it's a more broadly diversified index. And then the Dow is clearly not heavily tech overweight, which probably explains why it's lagging significantly. People have been kind of shying away from traditional value stocks and have been jumping in with both feet into the growth side of the equation here in the United States ever since probably midsummer. People are saying, and by people I mean pundits on TV, are saying there's going to be a huge transition or shift into value. But determining what really is a value stock is kind of up for debate at this point. We are going to see quite a bit of movement depending on who gets elected, but we're going to talk about that here in a few minutes. We think that there is still opportunity here in the United States, but realistically, the overall broad market is very, very expensive right now. And when I say expensive, that is in the traditional sense, right? Traditional price to earnings ratios. These forward-looking price to earnings ratios are very, very stretched. They're much higher than they normally are, even when the economy is really good. And I would argue that the economy is not really good right now. They're much more stretched than when we have excellent employment data, which obviously everybody knows is not the case right now. So a lot to think about, a lot to mull over. Once again, just to go back, we think there's opportunity in the United States, but it is not our best idea right now. U.S. unemployment data is pretty bad. I just alluded to that. Bottom line is that the data is not pretty. There's nothing good about this. People are starting to fall off of unemployment because they've been on unemployment for so long, and everybody that's ever had to deal with that or done any research knows that you can't stay on unemployment into perpetuity. So people are starting to fall off, ones that filed early in March. So that's kind of skewing the data just a little bit. We're seeing a lot of the data coming in for new unemployment numbers much worse than expected. That's not a good thing. Seeing unemployment rates still at 8% right now, even with over $3 trillion pumped into the economy from the federal government, is not a bullish thing, right? But we've always talked about rate of change. So when that starts to roll over and improve as it accelerates, that should be a catalyst for more economic improvement and could potentially give us another leg up in the market, right? But as things stand right now, there's a lot of uncertainty and people are not hiring. PPP loans are tapped out. There's just not a lot of money to go around, considering that overall growth outside of the tech space and outside of the e-commerce space is pretty minimal or negative. So that's why this employment data looks as bad as it does. I would say that if we see some sort of additional lockdowns, that's going to make things a little bit worse. But we're still banking on some kind of stimulus from the federal government that has yet to come. With the election right around the corner, I would be shocked if it actually got done in the next 5 or 6 days. But hey, we'll see. You never know. Speaking of lockdowns, etc., this is kind of a good segue into COVID. I've tried not to bring this up too much in recent videos, but the bottom line is it's here to stay for quite a while, so we got to touch on this. This is my old COVID chart that you guys remember from the Thursday Thought videos. I would love your feedback, by the way, on those. If you guys want to see those again, if you're looking forward to seeing live videos, shoot us an email over at info@cfgfinancialplanning.com. Let me know. I'm still trying to plan out our marketing moving forward, but I digress. The data is bad on these charts, okay? This data is like a little over a week old now, I think, and it is just not good. The daily case increase is spiking precipitously. We are seeing deaths increase, and we're also seeing hospitalizations increase. Now, keep it all in perspective. The overall death rate per capita or per person infected has gone down quite a bit. I think in the early stages of COVID, we were having some misdiagnosis. Hospitals were having conflicts of interest on how they were going to mark patients, how they were going to kind of check the box on cause of death because there was additional compensation associated with ventilator usage for COVID versus other things. So real convoluted, challenging process to wrap your head around. But the bottom line is deaths per case are going down, but cases are spiking, going through the roof, which is super challenging to deal with. A lot of people, especially political people, anybody talking about, the candidates, Trump's handling of the COVID situation, how Biden could do it better, whatever. I don't know. I don't really have an opinion. All I can say is across the board, across the world, we're seeing data that's really, really bad, no matter how strict restrictions are, no matter how quickly countries are locked down or locked down again. Great example would be Europe. We have Germany, we have France, we have Spain, we have the UK. Everybody is experiencing a spike at the same time. And once again, this slide is a little bit outdated because I had to submit this for approval a little over a week ago. But caseloads are even higher there, and they have much stricter requirements, especially in Spain and Germany right now. UK is looking to lock down again. There are periods where people are not allowed to go outside. They are making people go home at like 10 o'clock, nobody can go to restaurants, nobody can go to bars, et cetera, yet caseload's still spiking. So I'm not sure what we could do different here. That's not my job. I'm just reporting what's going on, and it's bad pretty much everywhere. We even have new spikes in China, which was saying that they had it completely under control, and then also South Korea, which did a nice job in the beginning, is seeing a resurgence of the virus. I think it's just the nature of this virus. But once again, I'm not a professional. I'm just reporting the data. Moving on to international markets, the EU is yucky. We were strongly considering and actively starting to move some additional assets into developed international because they've been trailing the U.S. for so long, and there was some fairly aggressive fiscal and monetary stimulus happening. But realistically, the data is real bad, and part of it has to do with how aggressively they're locking down their economies. This is kind of the relative argument for U.S. outperformance from some corners of the financial universe, right? We've stayed mostly open, and they're shutting down again, which is really affecting their data. To that end, though, they are considering another round of massive stimulus, which for all intents and purposes should be a done deal. The main issue that we have with that is that we have a bunch of countries with different interests, essentially not quite agreeing on who should pay what to whom and how much, right? But the bottom line is they've agreed they want to do stimulus. I guess it's not so different from what's going on here, although there it's not quite as politically motivated. It's more each country is trying to worry about themselves. Right here, it's each party is trying to worry about themselves. So it's not looking great there, but we still see opportunity. We're just going to tread a little bit more carefully, and we're going to, I guess, focus a little bit more on quality as opposed to taking risk or adding risk, especially in the EU portion of developed international. Moving on to China, we see China's over the hump. Their data has gotten progressively better. This is a rate of change thing. It's gotten progressively better over the last 6 months. Obviously, they were completely shut down for months on end, which, it's convenient. They're communist. They can pretty much lock everybody in their houses and nobody can do anything about it. So it's a different animal. Who knows about the efficacy of this data? I don't know how true it is, but by and large, commerce is back and rolling. Exports are rolling. Manufacturing is rolling there. So we're seeing some opportunities in China, even though we're a little uncomfortable with their accounting practices. We're a little bit uncomfortable with the geopolitical risk, with all the trade issues. But the bottom line is there are growth opportunities there. Rest of EM is kind of all over the place in terms of U.S. dollar strength. If the dollar continues to weaken, if we get a bunch of additional stimulus, this will provide a tailwind for EM, not only for their ability to service their debt, but also for their ability to grow, right, to borrow cheaply in U.S. dollars on a relative basis. So there's definitely opportunity there, but you have to tread carefully. Once again, it's not just, hey, go buy the big index and just hope for the best, right? Because hope is not an investment strategy, and that's not how we roll here. So we're being very, very thoughtful and very tactical in our emerging markets exposure. The biggest thing on the docket coming up this quarter is actually happening next week, and that is the election. This thing is going to be one for the ages, and probably not for the right reasons. Any way you slice it, people are going to freak out leading up to the couple of days before, and then after the results are tallied. If this is a contested election, holy cow, I'm talking Molotov cocktail party, cars on fire, dumpsters on fire, probably conspiracy theory festival. I don't even know. It's going to be a mess. But I do got some straight talk for you guys. I have some thoughts on platforms and what this could theoretically do for asset allocation and global markets. Now, keep in mind, nothing I'm about to say should be taken as a recommendation to buy or sell any security or any asset class or anything. This is just my opinion alone. So take it for what it's worth. This is what I got. Let's start with the statistical polling favorite, Joe Biden. This guy's a character. He's definitely making things interesting for us. His platform is a little bit confusing because the things that they're saying don't necessarily jive with the actual platform that's out there. But here's a few facts, all right? Taxes will go up. They will go up if Joe Biden is elected president. Now, by how much and specifically which ones totally depends on what the Congress looks like and how aggressively progressive they decide to be with their tax plan. But it's not this whole everybody under 400K is not going to see a tax hike. Okay, that is not real, at least if you believe what the platform actually states. Okay, because there are a lot of moving parts in this. I've done the research. It's not worth debating me on it. It is my opinion that taxes will absolutely go up. Okay, that's my opinion. To that end, it's not always a bad thing for markets if you see some tax increases. If it coincides with government proceeds being used responsibly and intelligently. Smoothing the deficit would be super helpful, especially for our bond market. Maintaining some stability in the dollar would be useful. If they were going to do some targeted infrastructure, which is on the plan, just not very detailed. If it was targeted and smart, that could be good for growth and for jobs. But by and large, it's just like spend, spend, spend. A lot of left-wing type of passion projects that have been floated for a long, long time are high on the docket for the additional tax revenue. Specifically, this is looking at green energy, renewable energy, high-tech corporate subsidies. All of these things are going to see some sort of tax break, some sort of stimulus from the federal government, which would be really, really solid for their growth prospects long term. And we could see some sort of incredible breakthroughs, right? Like, who am I to say that it's not going to work? On the flip side, big blue chip cash cow type of companies might struggle from this whole thing, and traditional energy producers would be looking at seeing their government subsidies completely vaporized. So there's certain parts of the marketplace that would really struggle. The blue chip type companies that I'm referring to, those are the ones that are going to be really hit by the additional corporate tax increase, if that in fact happens, right? Those are the ones that pay big dividends, make a ton of money every year, do stock buybacks, trying to add some additional value for their equity shareholders. All of those things would be impacted by a massive tax hike, and additional regulations never really makes it easy for companies to adapt right off the bat, but they always do. Eventually, they always do. Another thing would be socialized medicine, if that comes to fruition. Well, on the surface, it seems pretty awesome for kind of the country as a whole. At the same time, you're dealing with a situation where people are going to take advantage of it, and it's generally going to be run very poorly, right? We're not going to see some sort of major cost savings across the board unless we go to a pure socialist system, like you see in some countries, like Canada, or what you see over in Europe in a few places. It's not likely to happen. Realistically speaking, big pharma companies, they would struggle in that type of environment. For-profit hospitals would struggle. Insurers would struggle as well. I think the tough part, though, is where do you draw the line? Is the government going to completely take over the system or not? Is that even constitutional based on the way that we function here in the United States? Not for me to decide, just kind of giving you guys the information, the policy platform basics. The one thing I can say is companies are going to find ways to make money. That's what they do, right? So no matter how aggressive regulations get, no matter how aggressive taxes get, companies will find ways to make money. It may not always look great. It may not feel great in terms of offshoring again, because all of that repatriation that happened over the last couple of years. It is what it is. But companies are going to be investable at some point. I just think the big profit makers, the big cash cows, that kind of stuff, going to be a little bit tougher to justify current valuations if all this regulation and tax reform goes into place with a Biden election. Now, switching gears over to Trump, he is likely to lose this election, especially if you believe the polling data that's out there. But keep in mind, he was polling terribly even a couple weeks before the last election, right? Every single pollster out there was saying Hillary Clinton was going to run away with this thing, and she didn't. So you never know, right? I don't proverbially have a duck, or yeah, I did. That's a Freudian slip. You guys are gonna love that because I don't have a duck in the race, right? In this instance, it's really, really challenging for me to come up with an opinion on which one would be better. All I can say is, if Trump were to be reelected, there would be more of the same, which, I think it's so obvious that that's the thought process. They haven't even bothered to outline a bona fide party platform on what they're going to run on. All we've heard so far is he's going to do more tax cuts, even more targeted towards the middle class. He's going to make healthcare better, right? I'm sure there's something happening behind the scenes, but it's pretty much impossible for any of us to have details on this because it's not readily available. What I can say is looser regulations with a flexible kind of globally competitive corporate tax policy generally is good for markets, and it should provide a little more stability through the coming months after the election, leading into next year. I would wager to guess that if he were to win, there would still be a Democratic Congress. which would force him to do something in terms of taxes. There would have to be some give and take if he wants to get any of his policy through. So that remains to be seen, but I don't think that's going to come in the form of corporate taxes or any kind of additional regulations in the marketplace. That's just my 2 cents. We'll have to see how that whole deal plays out. I will say one last thing before moving on. Geopolitical risk is the one thing that could remain high. Tensions could continue to escalate on the geopolitical front, especially with our trade negotiations if Trump is reelected. So that's something to consider when trying to decide where on the globe you're trying to put your money to work. Whether you think his policy is good or bad is irrelevant. You have to be aware of the risks that are inherent with creating trade wars. One of my favorite parts of the video is talking about general positioning in the portfolios. As always, you guys know it's my shtick. Data dictates positioning, right? Across all models and strategies, we are pretty much implementing the same type of overweights and underweights. So everything that I'm about to cover is pretty much universal, obviously with the exception of the individual stock portfolios, because direct international stock investment is a little bit more restricted in those particular asset management styles. But for all of the mutual fund ETF portfolios and strategies, here's what we got going. Equity in the United States is still going to be a relative underweight. We missed a little bit of the prediction of outperformance of super high growth and higher risk growth stocks during the middle half of this year. And I think that's more of a reason to stick to our strategy of favoring quality, favoring some cash flow, favoring good balance sheets over the alternative, which oftentimes can be some of those high flyers that also carry additional risk with them. So we're going to stay prudent in that space specifically and maintain a small underweight. International equity developed specifically is going to be neutral, which is kind of middle of the road. If you're a client, you know exactly what I'm talking about. In your investment policy statements, you guys have percentages that we invest in each one of these asset classes. We're going to be right kind of in the middle on developed international right now. And we're going to actually pull in the reins a little bit on risk for the lower risk portfolio strategies that we have in place. Emerging markets is going to be a slight overweight across the board for the reasons I mentioned earlier, especially potential dollar weakness, and then also historic relative valuation discounts right now in the EM space. Just make them a little more attractive from a risk reward perspective. At least that is our opinion at CFG. Fixed income is going to be neutral to overweight depending on the risk tolerance. And then cash is actually lower now than usual. I know it sounds counterintuitive because we always like to have some cash, some dry powder available, but it's basically paying nothing as the risk-free rate is almost zero at this point. So we've redeployed that in some places, not taking on a ton of risk with our cash bucket, but we're trying to get a little more yield than nothing. Now remember, guys, each portfolio is specifically designed for clients' relative specific objectives, their specific risk tolerance, things that are important to them, all the way down to making preferences on ESG or in other words socially responsible investing strategies. Everything is unique at CFG, and we don't want you guys to make any specific investment choices or decisions by anything we're saying here. We're just trying to give you an overview of our thought process, where we are positioned now, and kind of where we're going. All right. Really appreciate you guys taking the time to sit around and listen to this. I hope it was stimulating. I hope you were able to learn something. I would love to take questions. If you guys need to do a review, if you're due for your review, or you just like to get in and chat about things after the election, we're booking out into January now because it's starting to get a little bit busy. But we can definitely do Zoom calls on a 30-minute window, something like that. If you are not a client and you would like a free consultation, please reach out at info@cfgfinancialplanning.com, info@cfgfinancialplanning.com. Please like and subscribe to our channel. We're going to be bringing out a lot of content over the winter, and we really look forward to communicating with you guys and getting reviews on the books because we miss everybody. Remember, hope is not an investment strategy. Have a happy and safe holiday season. Thanks a lot, guys. Take care.